This is a quote from de Condillac, who was a French economist back in the 1700s. And he says, from the very fact that an exchange is made, it follows that there must be a profit for each of the contracting parties. Otherwise, the exchange would not take place. Thus, each exchange represents two gains for humanity, because we live in what's called an exchange economy. Always trade value for value. Now again, getting back to basics of economics, okay, we have to recognize that every economy must always have exchange for exchange, value for value. Every transaction, always. Anytime anybody is given value and value is not given in return, what happens? That's right, welfare. It creates a situation where someone gained value or sustenance for not providing a product, which means somebody somewhere in the system gave money and not received anything, and someone received money and not gave anything. Both ways are bad. So it's up to us as individuals, because we can't rely on our leadership to do it, because they don't understand this principle. Or maybe they do. I don't know. All I can tell you is that every time you spend money, you should get full value. That's all I'm telling you. Expect it. Demand it, even. Now, this also goes to the line of help. Now, I want to cover something with you to help you with this. You as a professional, how do you derive the greatest value, satisfaction, love for what you do? You helped someone. Is that true? Of course it's true. Okay. How do you ensure that you can help someone? Well, you help yourself, absolutely. But you give them the greatest service you can, the greatest attempt at delivering the most quality value you can to that person. But you also have the right to require that they give you the help back by being a great patient. You have every right to expect that when someone comes to you for help, that they do what you ask them to do so that they can be helped. If they're unwilling to do that, then they're unwilling to be helped. And if they're unwilling to be helped, that's going to give you a loss. Isn't it? That's right. And that's not okay. So, as a chiropractic professional, whatever field you're in, I would suggest maybe having a code of client or patient conduct. When we tell you to do a certain amount of visits, like in physical therapy, a certain number of visits to get the results, then have them agree to come to all the visits. Of course. Okay? Agree that they're going to be on time for the appointment. Of course, no, you need to be on time. It's a double-edged sword, right? Or that you have to have them read something before they meet with you. Make sure they do it. Make sure they agree they're going to do it. Because your time is valuable, so is theirs. But they come to you to be helped, right? That's why they come to you. So, in the words of Jerry Maguire, help me help you, right? Okay? So, I would suggest having some kind of communication where you came to be helped. This is what I require of you to be helped by me. Fair enough? Now, when you go to somebody for help, you also have that responsibility. Because you go to them because you're trying to achieve your own goals, right? So you have the responsibility of a consumer of professional services to be able to be helped, to do what that professional is asking of you to do. Why do you think I wrote the Code of a Household CFO? So over 20 years of working with people, I discovered the 26 basic things people do to achieve optimum results, to work as a partner with someone like me. That's it. If you do those 26 points, it's beautiful. If not, there's a blockage on the help. It's that simple. So You have the right to expect help, and when you go to somebody, you have the right to expect you're going to help them help you. And that way, exchange can occur, value can trade. And that's what the best thing you can do for any economic problem. Does that make sense? Excellent. Okay, good. So, now you also have a tremendous amount of exchange that occurs on your 3 roles. Okay? Now, the first role you have is a practitioner. You deliver the highest quality service. We've already covered that. As an executive, what is it that you exchange? You exchange leadership, organization, training your staff, right? Marketing, public relations, managing the finances, strategic planning, right? All those functions you do as an executive, that's your exchange. You go deliver those products to your group. They then expand more into the economy. Then you have the owner exchange. What's your exchange as the owner? We're going to go over this in a little bit more, but ultimately, you are responsible for putting a business there. Now, part of that exchange is that business is there, it stays there, it has a culture, it has the practical investment and legal rudiments in, but it's perpetual. That word again, perpetual. It's the part of the exchange is making sure it gets into the hands of someone who will succeed you. That's called transition planning. Because just because you decide to get out of your profession at some point, whether by health or choice or whatever, is your whole community going to be ready for that? Or would they like to have someone continue on in your behalf? I would suggest probably the latter. So it's part of our exchange, our responsibility to do that. So what I'll cover here with you is transition planning. Now, the business viability part itself, being in marketing, all those things that are handled by your relationship with your consultant or coach in the practice management side of things. So we don't cover that. What we are going to cover is the transition part. So we're going to plan for transition. Now, the average business owner will spend 80 hours preparing a business plan. Remember preparing your business plan when you got involved in business? That long, arduous tome that you wrote to get the loan or whatever? Okay, 80 hours to prepare that and only 6 hours preparing the exit. Well, that's not good. Okay, and we got to find that the vast majority of your peers are not going to ever get involved in deriving any additional value out of their practice when they're done because they failed to plan for it, unfortunately. Okay, so what we're going to talk about here is planning your transition. Now, you'll discover that transition planning is a process done over the entire professional career, not an event, like a practice sale or closure. So people say to me, well, Christopher, I'm not interested in selling my practice. I don't want to do any transition planning. Okay, I got that. But this is a process done over an entire career. It's not because, gee, I got a letter of interest from someone who wanted to buy my practice, so I'm going to do all the window dressing and all that stuff and make it all pretty. You're going to lose $500,000 of value that way. But if you build it to sell at any time, whether or not you do, guess what? If you ever have to, it's not going to hit you by surprise. Okay? And we find that a lot more practice sales occur because they have to, not because it was planned that way. So I want you to be ready for both. So I created results-based transition planning. How about that? Now, results-based transition planning, again, the basic terminology, results, desirable or beneficial consequence, outcome or effect, based, a fundamental principle or groundwork, foundation, basis, transition, movement, passage or change from one position, state, or set to another. Now, what is transition planning also? Well, when you started your practice, who did everything? You did, right? Then you hired somebody and took some of those things that you were doing and gave it to somebody else. That is called a movement, passage, or change from one position, state, etc., to another. Transition by definition. Do you see? Now, all I'm telling you to do is, rather than thinking just to the top of the organization, being an executive director or the chief practitioner or whatever, I'm talking about going out to the board of directors and beyond that. We typically get stuck at the top of the organization, not out. And I'm talking about getting out on your terms. Planning, again, as we talked about before. So, results-based transition planning, in its essence, is the creation of the maximum transition value. The maximum transition value of a professional practice over one's entire career starting right now, as you sit here, to the end result of the ultimate transfer of control, income, and ownership. Those are the three factors of transitions. Control, who makes the decisions, who gets the income, and who owns it. Three distinctly different parts of a practice. Two others, based on a well-formulated and executed plan that optimally benefits the owners, the successor owners, the employees, patients and clients, and the community. Now, what is maximum transition value? Maximum transition value is the maximum economic and social value realized in a professional practice transition that optimally fulfills the personal and professional goals, that's a lot, it's a big mouthful right there, of the owners, successor owners, employees, clients, patients, and the community. That's a big role to fill. This may not be the highest price, but rather the greatest benefits for all concerned. The reason why I added this to the financial plan was for a couple of reasons. Number one, we had to find a way to have people understand the market value of their practice. We typically, unless we get a certified valuation, we really don't know the market value of our largest asset. So we have to use that as a financial planning asset, which of course isn't done. So we had to put that in. Then we had to figure out ways to handle that in light of the overall financial plan. But in 1999, I was doing some continuing education, and I took an H&R Block income tax course, which is a great tax course, by the way. And I was there, and I met a guy named Brian. And Brian is this young, 28-year-old guy working for a big corporation in town. And I'm answering all the questions, and I'm being a bit cocky and arrogant, and, you know, because I'm that way, whatever. And he looks at me, he says, you sure know an awful lot about taxes. I said, yeah, I'm a financial advisor. He says, really? I want to do that. You do? Yeah, I want to do that. So we talked a couple more times, and he says, I really want to come work with you. And I said, Brian, I'm just going to tell you right now, I'm going to sell my practice between 3 and 8 years from now. I like you, and I think you got what it takes. So I'll take you on under one condition. You do everything I tell you to do. The minute you don't do something I tell you to do, I'm done. He said, okay, I can do that. So he joined our firm, and over the next 2 years, I trained him in what I did. About the end of 2000, I went to him and said, Brian, I'm going to sell it to you next year. So I already made my decision that I'm going to go on and do what I do now. And he says, are you serious? I said, yep. 3 years. I told you 3 to 8. 3 years it is. He said, okay. So over the next year, I introduced him personally to every single client, whether on the phone or in person. I turned over all my information to him. I made it so that he could do my job flawlessly. Okay? We had a marketing machine. We were getting a referral a week that kept going through the transition. We had a niche. We had a good marketing system. We had all the systems in place. And he basically bought me out over 7 years. Now, the transaction was actually flawless, except I made a mistake on a stock trade about 6 months before I sold it to him, and we found out about 6 months after. And so when the accountant called and said, what happened here, I missed it. So I had to pay to correct it. No problem. Let's cut a check. Other than that, I got not one phone call, not one email, not one letter, not one anything from Brian asking me anything about the practice. And he continued to be in the top 1% of producers of the firm continually from that point out. Okay? So I was able to sell it for a value twice the average market. And I did it myself because I didn't have any guidance. I just figured it out. Okay? Now, that's the position from which I am telling you about this transition planning material. This is what I did to create value in my practice. And I think it's universally applicable to all professional practices. All right, now I want to get into the 9 steps of the results-based transition plan. Now, again, anytime we're looking at a codification of any subject, we want to get the defined result, and we want to work out the exact sequential procedures required to get that end result. So we're taking a look at a results-based transition plan. There are simply 9 steps that one can do in sequence to position your practice for maximum transition value. That's the product, the goal. Number 1, again, having a written transition plan, which has a lot to do with what your intentions are with the business, what your personal intentions are as far as your own personal goals, and more importantly, or as importantly, is what the transaction is going to look like. Because you're all going to go through some kind of transaction at some point, whether according to plan or not according to plan. So we have to assemble then a team of experts. Now, we're going to talk about this all in detail, but that's part of your social capital. The quality of the information and advisors you have is going to have a lot to do. A lot of economic value can be created with the right team. 3, having your personnel ready. Now, having your personnel ready covers lots of parts in it as far as the business growth, but it's also going to be how they are transitioned over to another owner at some point, and all of the factors that go into that. There's a tremendous amount of action done there. Then, of course, once you have a written transition plan, you've assembled your team of experts, you get your personnel trained, then you can build systems. And with Michael Gerber, the guy who wrote the E-Myth, that's a book that I recommend. E-Myth or E-Myth Revisited are a couple good books to read as an entrepreneur. He talks about what's called a franchise prototype. It's like building a machine that is like a McDonald's. It just runs like a franchise with systems. And then once those systems are in, then you can then duplicate those systems in other locations, just like any other franchise. So when you build practice systems, that's what builds the real long-term value of that practice, which then part of that practice system is continuing to make sure that the income is not only at a high range, but continues at a high range through a transition to somebody else. Because that's what they're buying. They're buying the predictable cash flow off of a practice. So the higher that is, and the more it's trending upward as it goes through a transition, the more value the practice has. Of course, then, what's created then are valuable assets. Okay, you have a valuable practice. And in that valuable practice, you have equipment, and you have intellectual property, and you have systems in place that create an income stream, okay, which are of interest to buyers. And then you have financial readiness. Now, financial readiness is of a couple different levels. One, making sure the practice has its finances in order, so it's clean and it's easily understandable by people that are interested in acquiring the practice. But you also have to make sure, in your personal financial plan, that your personal financial readiness is ready to transition out of a machine that makes income for you to another phase of life where that machine will no longer be there. Okay, then we have to have emotional readiness in place, all right? Because many of you are emotionally attached to your business. It's like a child, or it's like, it's a place that you created, it's your culture. And one of the worst things that can happen is to get an offer in from somebody who's to buy your practice. They electrify you with all kinds of big numbers. You go through a transaction, only get to the signing table and say, I really don't want to sell. And that's so common, as a matter of fact, that many business brokers now will actually charge a fee to the seller if they choose not to go through with the transaction because of not being emotionally ready. So there's a whole process we need to go through to ensure that we're mentally and emotionally in a position where we want to go off and do something else. And then finally, after all of that, then we take a look at a transaction. Only then, after all of this stuff is already done. Now, of course, what happens? Someone comes, we're just kind of building our business, doing our thing, all of a sudden someone comes along and says, I'm interested in buying your practice. Boom, right into professional transaction. We start at the end of the line. And then we wonder why we're not getting maximum value when we go to sell. Do you see what I mean? So we have to go through this proper sequence of actions. The transaction is the last thing. We don't enter there and try to go the other way. Do you see what I mean? So as we plan purposefully to create maximum value, we end up creating maximum value, and we have a much better experience because you're building a machine that probably is so efficient that you may never get rid of it. And that is totally okay. But you're going to go experience the next 10 years anyway. You might as well build a business that has maximum value to somebody else rather than not, right? You're going to be in there every day. So what I'm going to do with you now in this whole section is to talk about how to create that maximum transition value. So here's some things that we have experienced in this world of transitions. Okay, there are barriers to transitioning out of a professional practice. Number one is that we do not view it as an investment. We view it as a job. Now, how many of you through the course of today have maybe changed your perspective on your practice from it being a job to being an investment? Very well done. Anyone not have that epiphany yet? It's okay. We got time with you. Okay. And we have other implements that might, get you to change your mind. Okay, number two, the illiquid nature of the business is not appreciated until a time of sale or other transition. How liquid is your business? Now, that's a very important question. Liquid means, can you turn it into cash? So, can you sell your practice today to someone? Nope. Then it's illiquid. Now, if you owned AT&T stock, can you call a broker or get online and go sell and get the cash tomorrow or in 3 days? Yes, you can. That's liquid. See the difference? But you don't appreciate how illiquid it is. Now, let's take a look at the fact that you may not have an associate. You live in a state that requires a licensed person to own the practice. There are no potential buyers in your market. How liquid is your practice? You're done. But if you plan for a liquidity, whenever you might need it, by putting those basics in place, then how illiquid is it? Not nearly as much. And that lessens risk, which raises value. You see the difference? You see how that works? So that's really important. I want you to understand. You're going to go through this business transaction one time. Unless you start another firm and do it again, okay, which I did. Others can do it, okay? But we want to make sure that we do it correctly, right? Because what can happen is life not going according to plan. Now, how many of you have an associate now? Okay, now keep your hands up. How many of you have an associate that can buy your practice? See that difference? Okay, we're going to talk about that quite a bit because that's very important. It's all well and good to have an associate. It's more important to have an associate that is being groomed to take over for you. Whether or not you do it, that's not the point. It's if you choose to do it. Very different. More freedom, more control. Next one, lack of diversification is not understood. That's why I went over this household risk index, right? And how risky your business is compared to other investments and how we just don't diversify. That's a big problem. All your wealth is built in your practice. No understanding of strategic options. There's 7 basic options on how you can sell your practice. 7 fundamentals and 1 million variables within them. And we're going to cover those 7 options so you can start understanding and thinking out, working out your own transition plan. And finally, there's no definite plan for life after the business. Now, that's critical There's a big, big difference between having a practice sale because someone else told you to sell it, like retirement's age 65. Who said? That's one of those things that's true because people keep repeating it. Do you know where that came from? Otto von Bismarck. You know who he is? Otto von Bismarck was a chancellor of Germany in the late 1800s. And Otto said, hey, you know what? All you 70-year-olds in the factories, get out. You're getting slow, you're gumming up the works. We'll pay you just to stay home so we can get all these young bucks from the military into the manufacturing plants. So we'll pay you not to show up to work. Great. And it worked. His son Wilhelm comes along and says, 70's too old. Because how old were people supposed to live back in 1879-ish? 56, I think it was. 56. See, if you made it to 70, congratulations, right? Okay, Wilhelm comes along and said, we got room. 65. If you're over 65, out. Young bucks come in, take their jobs. Okay, 1933, the New Deal, Roosevelt says, we're going to establish Social Security. What age is retirement? 65. Where did he get that from? No. The Social Security Administration says right on there, it did not come from independent research. I don't know. All I can tell you is I find it fascinating today that people will schedule out the calendar of their lives based on some opinion some emperor gave over 100 years ago. And that's really what it is. Who said that when you're 65 years old, you hang up, that when you're in the greatest level of production, intelligence, experience, and ability of your life, to go off and get a gold watch and go out to pasture? Are you kidding me? That's ridiculous. So if you don't ever sell your practice, good for you. Good for you, okay? But you have to have a plan for your life after work. Because here's what happens. You have a sale, a retirement. I hate that word, retirement. Now I'm getting all upset. Retirement comes from the French word reterre. I can't pronounce French. My apologies to the French people. Reterre, something like that, means to draw back. Now, how many of you want to go through life drawing back? Huh? Not me. Not you, you recalcitrant. You know what recalcitrant means? You've heard me before, right? Hard to control or manage. Insouciant. Insouciant's carefree. Worry-free. So you're recalcitrant, insouciant entrepreneurs. I can't see you retiring either. Fine. This is a phase of life, a transition from one stage to another. Not, I'm going to draw back. Do you see the difference? That's why I don't like the word retirement. I might coin another one someday. But anyway, there's this event that occurs. And you go through on this purpose, and you get to this event here. And if you do not have another game over here pulling you into the future that is more exciting, riveting, passionate than what you're doing right now, don't do it. Because what will happen is you'll get here, the game is over, and your life will do this. And I've watched it happen to person after person after person. People say, I want to sell my practice. Why? Because I want to go off and do something else. What? I don't know. Great. So they sell their practice. They blow their money because they don't have a plan. 4 years later, they are where? Working as an associate in someone else's practice. And all the life's work they put together to build their practice is now gone. That's clockwork. That's predictable. That's the normal state of affairs. That's ridiculous, is what that is. So, I urge you to have something going on in the future that is so interesting and exciting and has your passion and energy that it pulls you through a transition. Not, I'm going to sell my business because I'm done. I'm burned out. Come on. But many people do that. So part of our transition plan is, what's the next adventure? And this will become just a step in the future track, not an end of an era. It's a mindset. Very important. So that's why we spend a lot of time on emotional readiness. Big deal. That's the last thing that's going to go in before you ever get here, if you ever get there. Okay, let's move on. Privately held businesses typically are the largest asset owned by the household. We already know this. The primary source of income, that's not a surprise. The means to pay for your lifestyle, pretty obvious. A method of accumulating and transferring wealth. Let's stop. Accumulating and transferring wealth. I'm going to talk about accumulating wealth. Now, how do you accumulate wealth? Well, the way you accumulate wealth, first and foremost, is don't spend it all. Accumulate some of it. What does accumulate mean? Gather. Pet it, right? Not just, it's gone. But we live in a consumer society, and as perception management would have it, what are they telling us to do? Go spend it all. You know, watch financial news for a minute, and listen to the economists. And they will also, what they'll do is they'll say, well, if consumer spending is up, the economy is pretty strong, and consumer spending, and more consumer spending. And they're basically saying that if consumer spends themselves into a level of debt that can never be paid, everybody's going to be prosperous. I mean, listen to it. It's just completely illogical, right? But that's what you hear. Okay? When we go to financial planning conferences, these PhDs get up there and consumer spending. We're like, oh my, are you kidding me? The Matrix. Okay? So we want to avoid that particular issue and accumulate and transfer wealth, which means you have to live within your means and reinvest in your business to create that value. That's called viability. And you have things that you want to achieve whether or not you're here to enjoy them, right? You accumulate assets for your own purposes. What happens if you're not here? What happens to those assets? Do you want them to just go off into the ether? Given to the government? How many of you have charities that you would support? Or causes that are greater than you? Or grandkids? Or children? Or other family members? There's all kinds of things to do with that money. That's part of your legacy when you build that business. It's part of your mark that you made while you were here. So let's not fritter that away because we just don't plan. Moving on, what's at stake? Your wealth can be diminished by a lack of a plan. We've already covered this. Adverse changes to the practice. Now, this drives me crazy. Adverse changes to the practice. Here's a situation I see happen a lot. A dentist, just for example, will say, you know what? I want to slow down. I'm getting like 55, 60 years old. I'm doing okay. I'm going to start slowing down. So what's the first thing they do? Cut back the hours. I'm going to go in 4 days a week instead of 5. Great. So we're just going to close the office on the 5th day? Sure. Now I went down to 3 days a week. Now I went down 2 days a week. And what happened to that business that was making a couple $1 million a year? Frittered down to nothing because they didn't want to work. That's how adverse changes the practice. You have the owner changes their mind. That's the biggest first adverse change of the practice. Second biggest adverse change is something outside the owner. You know, where you have changes of demand of the services, or maybe your business was dependent upon maybe a military base, and the military base closed. That'd be an adverse change, right? That could diminish wealth. Those are outside, and those happen much, much less than the owner saying, you know what, I'm just done. Because we all hit that point, you see? So, that is where wealth is diminished. Next one is changes in the economy or industry. Okay, how many of you experience lesser reimbursement or lesser money per service you're providing? Okay, in many industries, that's happening. Therapy, for example, okay? Or even the economy itself. When we go through a recession, do people come out and get services from you? Is it a little harder to do marketing and things like that to get people in the door? Sure it is. Okay, how about taxes? Those always diminish your wealth. And lack of a qualified successor. Now let me ask you a question. Raise your hand if you have a successor for your business that you've already named. Wow, 3, 4. Really good for the 4 of you. That's really good. Very well done. Okay? Now for the rest of you, we're going to handle that before tomorrow afternoon. So if you got someone in mind, start ripping out the phone, start texting, and let them know you're it. There's a big word there I want to make sure that we cover. Qualified. What does that mean? They fit the requirements that you have laid out to run your business, to own it someday. Inefficient deal structuring. Yeah, that's just a common thing, okay? Working a deal, there's all kinds of moving parts to a deal. That's why you need a team of experts. Fees and expenses, of course, you know. Now, a fee or expense is not a problem as long as you're getting what for it? Value. Always get value for your fees and expenses, and it's never a problem. Here's the one that has my pet peeve right here. Misappropriation of liquidation proceeds. There's only one way to handle the money you get, the big check you get when that money comes in the door. You go to the table, you sell, I'm signing the contracts over, here you go. Here's your check. You know, you have to push your eyes back in your head because you never saw numbers that big on a piece of paper before that had your name on it. The first thing you do is take the check, walk it to your bank, and give it to the teller and say, deposit this in my account. Good. Do not do anything else. Forever. She said for how long? Forever. Your first inclination when you get a big chunk of money in your hand is to do what? Spend it, because we all love to spend money. Of course. So we always buy that motorcycle we wanted. Yes, that red Harley or the Winnebago. Or, oh yeah, we forgot to pay off that massive debt that we forgot about. Or, yeah, you know, my friend needs business money to start a new business. We'll just loan it to him. Again, I don't make this stuff up anymore. This is all actual stuff. No, you do not spend one penny until you have worked it out in your financial plan before the money hits your account. Because if the money hits your account and you have no disciplined, detailed plan on how you're going to reinvest the money, not spend it, reinvest it, you will blow it faster than you can blink. You think I'm kidding? Because the greatest emergency du jour is going to come up the day after you close. It always happens. I can give you one case study after another after another. No. You figure out, because if you do not reinvest that money, the proceeds of your business, to create income for the rest of your life, you will destroy the income for the rest of your life by blowing it on something else. Don't do that. And that piece of advice right there is worth 6 figures to you. Maybe 7. Just that piece. Okay? So I hope that alone was worth you coming.